Government bonds are debt instruments issued by a government to raise money for funding its operations, projects, or to manage its debt. When you buy a government bond, you're essentially lending money to the government in exchange for regular interest payments and the return of your principal amount when the bond matures. They are considered one of the safest investments because they are backed by the government's promise to repay. Here's how it works. A government issues bonds with a face value, the amount you'll get back at maturity, an interest rate called the coupon, and a maturity period. The maturity can range from short-term, a few months, to long-term, 10 years or more. For example, if you buy a bond with a 10,000 Indian rupees face value, a 5% coupon rate, and a 10-year maturity, you'll receive 500 Indian rupees annually in interest until the bond matures, at which point you'll get back your 10,000 Indian rupees. Government bonds are sold through auctions and can also be traded in secondary markets, allowing investors to buy or sell them before maturity. They're a key part of the financial market and are often used by governments to finance infrastructure projects, social programs, or manage budget deficits. One major benefit of government bonds is their safety. Since governments are less likely to default than companies, these bonds are seen as low-risk investments. In many cases, they are even called risk-free investments, especially in countries with strong economies like the US or Germany. For example, US Treasury bonds are considered among the safest assets in the world. Government bonds also offer predictable income, making them popular among retirees or conservative investors. The fixed interest payments, or coupons, provide a steady stream of income over the bond's life. This can be a valuable feature for anyone looking to balance riskier investments like stocks. Let's break it down with an example. Suppose you buy a 5-year government bond with a 1,000 Indian rupees face value and a 6% coupon rate. Every year, you'll receive 60 Indian rupees in interest, 6% of 1,000 Indian rupees, and at the end of 5 years, you'll get your 1,000 Indian rupees back. If you sell the bond before maturity, the price you receive will depend on market interest rates and demand for the bond. However, government bonds are not entirely risk-free. Interest rate risk is a key concern. If interest rates rise after you purchase a bond, newer bonds will offer higher yields, making your bond less attractive. This can lower its price if you want to sell it before maturity. There's also inflation risk. If inflation rises significantly, the fixed interest payments from the bond lose purchasing power over time. Governments issue different types of bonds to cater to various needs. For instance, Treasury bills, T-bills, are short-term bonds with maturities of less than a year. Treasury notes and Treasury bonds are longer-term, ranging from 2 to 30 years. Some governments also issue inflation-linked bonds, where the bond's value adjusts with inflation, protecting investors from rising prices.